Hello and welcome back to the Note. We have had a generally poor start to what could be a momentous week. Stocks down, particularly in Asia, also in Europe and to a lesser extent in the US. That is largely driven by the latest news we've had from China. Very poor fixed asset investment numbers over the weekend. That has a knock-on effect to commodity prices. It has a knock-on effect to confidence, particularly the case in the oil market, where you've seen Brent come back down to its lowest level in some 2 weeks. Some signs that the big recovery people thought was underway isn't underway after all. For now, I'd like to talk about the slightly longer term. Last week, you'll have seen I interviewed Professor Robert Shiller of Yale University. That provoked a lot of comments, and I'd like to answer a few of them. This is his cyclically adjusted price earnings ratio, or CAPE. It takes current price as a multiple of the average of earnings over the last 10 years. And as you can see, it suggests that stocks are very expensive at the moment, even if they're still nowhere near as expensive as they were at the top of the dot-com boom back in 2000. Now, it's correctly shown a number of big tops and bottoms. Many people are disgruntled that it is suggested you should be out of the market for the last few years, when of course the stock market in the US has gone up. Why do we do the cyclical adjustment? Well, let's take a look at US earnings over the very long term. This is on a log scale, and you can see that earnings are indeed extremely cyclical. PE multiples should take account of this. They should be lower when people know that earnings are at the top of the cycle. They should be higher when people know that earnings are at the bottom of the cycle. Therefore, when a PE is high at the top of the cycle, that is a particularly worrying sign. Note A, that we appear to have been at the top of the cycle in earnings, and B, that cycle appears now to have turned. Earnings growth is completely flat for this year. It looks as though we are moving down into the declining stage of the cycle. It's therefore rather worrying that we're doing so with stocks looking particularly expensive. Now, another point about CAPE is that it doesn't help you with timing. It gives you a good idea what's going to be happening over the next 10 years. It doesn't tell you whether the market is imminently going to fall. Professor Shiller himself is completely frank on that point. Nobody disputes that you can't use CAPE for timing. However, he suggests if you take a look at confidence about valuation, which he has been measuring for a number of years, that does tell you something quite interesting. What this chart shows, it's derived from people, from the numbers who think that the stock market is either overvalued, undervalued, or just about right. The lower the number, the more people are worried that it's too expensive. And you can see that there has been a steady loss in confidence in valuation over the last few years, both in institutions and in retail investors, even as the stock market has continued to go up. Nobody has particularly believed this, but they've kept on buying. That, according to Professor Shiller, is a sign that this is a bubble. If you take loss of confidence in valuation with the final beginning of a decline in earnings, that does add up to a suggestion that the beginning of the next bear market cycle could well be at hand. Does it really help us time it down to the week or the day? No, but that is the argument for why CAPE matters.